Good morning, everybody. I am Antonio Edoardo Bargellini. I'm from the Department of Statistics. Today, I'm going to talk about the least squares Monte Carlo valuation of life insurance contracts with surrender option. And it is a joint work made with Professor Giulia Spaletta and also Luca Gruppi. So the principal aim of this talk is about the surrender option in life insurance contracts. It is a particular type of contingent claim, which gives to the policyholder the right to exercise to exit the contract before the maturity. And I will introduce the problem, so talking about the valuation framework. Then I will talk about the method that we have implemented in Mathematica, which is the least squares Monte Carlo, and then some numerical tests. So the aim of this work is to find a fair price for an endowment link in insurance contract. So, what is an endowment link insurance contract? First of all, it is a contract that gives to the policyholder two types of benefits, one in case of death before the maturity of the contract, and one in case of survival at the end of the contract, so if the policyholder survives up to the maturity. And this is another particular thing of this contract is that it is equity linked. Equity linked means that the benefits of this contract are linked to the performance of a reference asset or of a reference fund. In this case, the reference asset is S of t, which is modeled as a geometric variant motion by this stochastic differential equation. This stochastic differential equation, as you can see here, as in the diff part, the risk-free interest rate, and in the fugitive part, it has the volatility of the reference asset. Moreover, there is also the Wiener process, which is actually a variant motion. And the time for that we observe is from the beginning of the contract, so time 0, up to the maturity, which is time big T. Then, as I told, the benefits of the contracts are three types in this case, because we have the benefits in case of survival, the one in case of death, that is usually in the endowment insurance, but we have also the benefits in case of withdrawal, which is the one that the policyholder receives when he exits from the contract, so when he exercises the surrender option. And these benefits are, as I said, related to the performance of the reference asset, S of t. In particular, as you can see here, this formula tells you that the benefits are equal to the initial value of the reference asset times the maximum between the first quantity is the performance of the reference asset. So if this ratio is greater than 1, it means that the asset is performing better than the initial price, and so this is something that is good for the policyholder. But since this contract depends on the performance of something that can be very volatile, we have also a minimum guarantee, which is represented by this type of this quantity here, which tells you that which is linked to the minimum guarantee interest rate, which is R of I. And clearly, these benefits are equal to, in the case of survival, they will be received only at time big T, because only if the policyholder survives, we receive the benefits in case of survival. So the last thing that we have to know about the model is how we modeled mortality in this framework, since we are dealing with life insurance contracts. First of all, we followed the literature, and so we implemented deterministic force of mortality, which is mu of x plus t. In this case, we used a variable force of mortality, which is represented by this expression here, in which the parameters A and B are estimated starting from the life tables. So we use the data set from 1872 to 2020. And for each of these here, we estimated the parameters A and B. And in this formula, X is just another parameter, is the age of the individual. And this is a common approach used in literature, and it is also quite fast to be implemented in simulations. But we thought that it was not enough because it's not so realistic in some sense. We assume that here the mortality does not change over time, and so it is always the same. The parameters changes according to the data, of course, but the mortality structure doesn't change. So we thought about another method, another model that could overcome this issue. And we found that a very common model used in mortality forecasting is the Lee-Carter. Lee-Carter is a model that tries to give forecasts about the central mortality rate, which is M of xt. This is data that can be extracted from the life tables. And then, according to this model, there is you can estimate the elements of this model and then perform some forecasting about this model. In particular, it has also another very important aspect, is that it is a stochastic mortality model, since the last element is a stochastic component. And so we used it in order to perform better simulation about the evolution of mortality. And the problem about using Lee-Carter is that in simulation it takes more than you just using the available force of mortality. So on one hand, we have the easiness of using available force of mortality, which is very fast in simulation. On the other hand, Lee-Carter is more robust in the sense that it computes the evolution of mortality better, but it takes more time to make simulations. So we try to use a compromise between the two, and we will also add another feature. Indeed, both the two models does not take into account the cohort evolution of mortality. Cohort evolution mortality means that you see people who are born for example, in 2020, and then you see how much of these people are alive in 2021 when their age is 1 year old, and so on. See, this is something that the basic Lee-Carter model does not take into account. It just see the mortality, how it evolves over time, but not considering each cohort. So we add this feature, and it's something that we are still testing, because there are pros and cons about using this model. But we thought of using the Weibull model, but looking at the life tables in a diagonal way. In particular, what we've done is to use the values of A and B that we have estimated starting from 1872 to 2020. And then once we have done this, we try to make inference about the parameters of the available force of mortality, and so projected this parameter and finding the parameters over starting from 2020 up to 2030. And then what we've done is recovering the mortality data starting from the parameters that we have forecast. Once we have the data generated from this type of procedure, we have performed we have fitted the Weibull model in a diagonal way. So considering the data, as I said, for the one who are born, for example, in 2020, then the data of mortality of the one who have 1 year old in 2021, and so on. And then we estimated again the values of A and B for this type of data. So this was the valuation framework. Now I will talk about the method that we have implemented in order to price this contract. Indeed, the problem of this contract is that there is no closed form solution for the contract value at time zero. And this is a feature that deals with American options. Indeed, the surrender option is actually an American option. And so we have to use a numerical approximation for the value of the contract at time zero. We have used a method that was introduced by Longstaff and Schwartz in pricing indeed American options. And this is the least squares Monte Carlo approach, since it combines the Monte Carlo simulation and the least square regression for estimating something that we don't know, and I will talk to you about it later. So first of all, the first step that we have to do when you perform least squares Monte Carlo is perform a simulation for n path for the reference asset, and then also make the simulation for n instance of that, which is denoted by TK. Then, once we have done this, we have, for example, 1,000 simulations, and then we have to initialize the ex-post realized benefits. In particular, what we do is a choice between if the simulated death, instance of death, is lower than the maturity, then the ex-post realized benefits will be equal to the benefits in case of death occurred at the time of the simulated death. Otherwise, it means that for that specific path, the policyholder is alive, and so the initialized benefit is equal to the benefit of the contract to the benefit in case of survival, and it will be set equal to at time big T, because it is the time in which the benefit in case of survival is paid to the policyholder. Then what you have to do is to introduce the least square regression. The least square approximation, it is used in order to give a value to the continuation value. What is the continuation value? It is something that in principle we don't know, because it's the value of the contract that the policyholder would receive in case he would not exercise the surrender option. So this is something that clearly we don't know, and we have to estimate it in some sense, because the policyholder makes the decision in a rational way. So if now at time, for instance, at time 1, it is more convenient for him, for her, to exercise the surrender option, it means that the value that he will receive without exiting from the contract, it is lower than the one that he receives right now. So we have to we have to approximate this value that we don't know, and based also on this value, we are able to modify the ex-post realized benefit and comparing to the benefits in case of withdrawal, in case of exercising the surrender option. So in order to do so, what we do is to discretize the time span into small step TJ, and then we proceed backward. We start from time big T, and we proceed backward according to the time step we chose, and we make some checks. First of all, we check that if for that specific path, the time in which we are, it is lower than the simulated death. It means that for that specific path, the policyholder is alive. And then, first of all, we discount the ex-post realized benefits by discounting by multiplying by the discount factor. Okay. Then, what we do is to perform the least square regression of these discounted ex-post realized benefits with respect to a set of basis function, which is this one, which is a combination of the reference asset and the benefit in case of withdrawal. Then, once we obtain this regression, we obtain the continuation values for each specific path, and then we make the last check, and this is the check that a rational policyholder makes. So it checks if the benefits in case of withdrawal, if it is higher than the benefits than the continuation value, it means that it's better for him to exercise the surrender option and exit from the contract. So in this case, what we do is to update the ex-post realized benefits and set it equal to the benefits in case of withdrawal. And so we proceed backward, starting from the last time step up to to the initial value. Once we arrive to 0, we have n continuation and ex-post realized benefits. And since we are in a Monte Carlo approach, what we do is just a simple average of the values that we obtained, and we obtain V0, which is the value of the contract at time 0. So clearly we have made some numerical applications, and we've done it creating a user-friendly interface in Mathematica, in which you can set all the parameters. And there is also a possibility to save the results in a file so that you can replicate the test. And what we have seen that the results are comparable to the one that are obtained in the literature. This is an example of the graphical of the interface that the user can use in order to make simulations. So what you can do is to choose, for instance, the interest rate, the minimum guarantee rate, the volatility, the initial value of the reference asset, the maturity, how many samples you want. You can also choose the year if you want to make, for instance, some comparison between how much it will cost this type of contract. I don't know, 20 years ago with respect to now. Clearly, the last data available is up to 2020, so we use them. Then there is also another features that we can change. We can change the gender if you want. So you can see, and there is a difference between female and male cases, and it is related to the average life expectancy. And then you can choose the age of the simulation, and then also the mortality model that you want to use. So the Webull one, the Webull diagonal, which is the one that we have implemented, and the Lee Carter. And so this is the interface. And here there are some results. As you can see also from this quotation here, that what you have obtained are the results that are in comparable to the one of the literature, and they're also in line with how we expected. Indeed, as you can see, as long as R increases, both the European and American prices decreases, and this is something that we expected since the interest rate makes this effect on prices. And on the contrary, we had the opposite for the volatility. As long as the volatility increases, the prices increases because clearly it is more volatile. And finally, about the maturity, the effect of the maturity on the European prices is not clear, because there is no clear trend according to the model that we've used. Something that I didn't say is that this means that it is the European price using the variable for some mortality. The European price means that it is the contract without the surrender option. So it is a simple endowment insurance, while the American one stress the fact that there is the surrender option, which is an American option in the end. So this is the comparison between the contract with the surrender option and the contract without the surrender option. And as I was saying, as T increases, there is no clear trend in the European price, while in the American price there is, because as T increases, the American prices increases. And something that it increases is the difference between the two, between the American price and the European price. And this is something in line with the fact that as the maturity becomes larger, it is more convenient at some point for the policyholder to exit the contract and exercise surrender option. So the surrender option, which can be estimated as the difference between the American price and the European price, becomes larger. Then this is the results that we obtain, trying to figure it out if there is a difference between the female and the male case, and there is indeed, because in all these cases, the prices related to just the female dataset are higher than the male dataset, and this is something in line with the fact that female have a longer life expectancy than men. So this is just an essential bibliography of what we have followed, and thank you very much for your attention. And so if you want to contact me, this is my contacts.